Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, October 31st, 2024. It's 2:10 p.m. Eastern Time as I'm starting the video, and I just wanted to get another one out on the markets and loop in the semiconductors too. Big sector, in my opinion, very important to the market, which is pretty much everything. Stock market is the economy. I've zero doubt that it's been holding up consumer spending. It's a positive feedback loop. Stocks go up, wealth that goes up. Housing prices have remained high for various reasons, including with the kind of the mess the Fed created with locking people in at the low rates for too long, and therefore taking a lot of inventory off the market. So that's also buoyed up prices, and we all know those are the two biggest things. There's in this world, I hate to say it, we all know it, the haves and the have-nots. The haves are the ones that keep the wheels greased and have most of their wealth in housing and stocks. That's their primary wealth. So those two things go hand in hand with consumer confidence, consumer spending, and of course, we all know consumer spending is over 2/3 of GDP. All right, what am I talking about? Well, it's all, the charts are stacked and they've been building for a while. So I'm going to just go over the levels to watch what's going on here. And again, I want to reiterate that Amazon and Apple report today. To me, the technicals, like I said, are clearly pointing to more downside in the coming months to year plus. However, near term, if they like what Apple and Amazon collectively are selling and they pop it up, we can certainly make a marginal new high as long as it's marginal, and that's relatively within, let's just say within 10% of, or actually there's the previous high, not even that much. I'd say we'd probably cap within 5% of the previous high. All right, and now that doesn't have to happen. We already put in a divergent high back here. We put in a bearish engulfing candle. So far, that is the top in the all significant, all important Nasdaq 100. We have negative divergence here again on the daily time frame, and again, if we make a marginal new high, it will have even bigger. It'll extend the existing divergence that was here at this previous high. So that's kind of in a nutshell. And I know I've been covering that forever and a day, and we'll see what happens after today especially. So there it is. So far, the breakdown is looking pretty legit. Again, Apple and Amazon have the potential to change the trajectory, but what we saw and what I think the street expects, you're going to hear big capex plans for Apple and Amazon, because they have to. There's this AI race. It's kind of like, I said a few months back, it's like the space race back in the 60s between the Soviet Union and the United States, and this is the AI race between these big tech. They're the the world leaders now, if you will, or at least the stock market leaders. And so I think everybody would be shocked to hear Apple reined in capex spending on AI, and Amazon as well. So now, where I'm going with that is that's why you're seeing Microsoft getting beat up pretty bad today after a blowout quarter, and Meta too, because again, that's what at least the media is assigning the negative response to their earnings. So we'll look at here. Let's just look at those two real quick. There's Meta right on the line right now. Again, this is a beautiful uptrend line, yellow because it's very significant, and coming off that divergent high. So a sell signal, solid break and or close below that level would trigger a sell signal, and then bring down Meta quite a bit. Again, I'll cover targets. It's if you're going to trade this one individually, I'll give you some price levels. You can kind of see on my chart I just marked up. These are really the three in minimum targets. That's more of a S1, meaning first support level, or BOD, benefit of the doubt. It's a very good level, by the way. So I'm going to right now set an alert there. That's at 540.23. You can call it 540 if you want. 1, 2, 3, 4 tags at that level, and then a breakout to new all-time highs. If you're bullish, you can buy a back test to that level. But if it breaks, that's going to be a failed breakout. You've got the 200 days below that. If they give way, then things are going to get ugly, in my opinion. And that's a very likely target there, 456. That would be a drop of about 20% to get to that target. Next target, 413.64, and let's just stop there for now. We'll see where we go. By the way, if that happens, I'm going to turn on my volume at price histogram bar. you're going to enter a thin zone on Meta, as well as a lot of these companies. I just turned on volume at price histogram bars. They show you exactly what that sounds like. The volume traded each price. So you can see Meta was in this trading range. I have one little brief stint down below it, but other than that, for months, really almost all the year, it's all this year, since the beginning of February, it's been locked in this sideways trading range. There's a breakout to new highs. Any failure back down below there will most likely, this is just how it works, a failed breakout will probably bring us down to at least the bottom of the range. So that's therefore that call of a 20% drop, and not from the highs, but from where we are if we break down, that I think is a likely target. Now, if that happens, and again, I'm getting 3-4 steps ahead because we haven't even broken down below the trend line yet, but if that happens, this is a big thin zone right here, meaning very few trades occurred. You had this breakout here, back here. Let me turn down my lines a little bit so you can see it. Okay, that's a little too much. So you can see we had this other trading range right here, period of consolidation, right, on Meta. And it broke out there, little back test, and then off to the races. And it filled that thin zone pretty quick. Went up here and then gapped up there to the top of it. So again, that was just a gap backfill right there, or near backfill. And my point being that thin zones often work like gaps, because there's gaps you have no trades in between. Thin zones you have very few. So if you get that 20% drop, sure, we'll probably have a reaction there. But if it breaks, which based on the longer term charts, which I'm not even going to get to in this video, weekly charts, monthly charts, I think there's a good chance we would ultimately break that after a reaction there. And then that would constitute, let me just measure from the highs. Let's just assume Meta peaked. That's going to be about a 45% drop, and that's exactly what I've been calling for in QQQ, a 45% drop. So to my final target that I gave you back all the way back in June, late June, right before market top, before QQQ top. All right, so that's Meta. We already had Microsoft report. Microsoft clearly post earnings trading below there. But again, Apple and Amazon have the potential to, foil these breakdowns, but not my expectation. Charts say that they go, south, whether it's immediately or within the next few weeks, even if they have a little post earnings pop. So I want to do the video to just kind of convey my thoughts that, number one, I still maintain those longer term downside targets, and they're very, big hit, let me just go to them. Very lucrative if you're a short seller, especially considering stocks tend to fall a lot faster than they rise. And more so also on that same vein, because stocks tend to fall a lot faster than they rise. There's a great example. There was the last correction. We were short at the top, covering at the lows and going long. But you can see in just a matter of 1, 2, 3, that's pretty much right here. We'll count from that candle in 4 weeks. Less, because there was that intra-week candle there. So yeah, we'll call it about 1 month. 4 weeks, we dropped a total of about, high to low was about 17% from high to low. And you can see what it did. It wiped out, I'm going to go back here, all the gains that QQQ made going back, my little pop-up box on the left, for almost 7 months. So 7 months of gains were wiped out in less than a month, right? That's how it works. And here you can see back here, you had that initial run down. If you want to go to that level, you can go there all the way. So that was took 10.5 months, and it wiped out all the gains made over the last 2.3 years right there. So again, you can do it yourself. You can go there. COVID wiped out years of gains in 6 weeks. And that's, again, it's just the nature of it. So that's why I like shorting. But you got to be quick. You got to be, you can't be too late getting in, and you most certainly can't be too late getting out. As we knew, as you know, we had an explosive rally off the August 5th lows once this was over. If you waited even just a few days for Kramer, whoever, to tell you to buy, you missed half the run right there. You can see within a week or so, most of the gains were made on that initial pop right there. And since then, QQQ, we're actually right back to that coincidentally right now. So you see we had this initial run here off the bottom, rallied in a matter of 2 weeks. We went up about 15%, and we're back to that level right now. All right, so let me just cover the rest of them real quick. Apple is yet to report, but they're clearly below. Remember, I laid this out for you as a trade idea. I said, look, you can take it ahead of earnings, but you want to, ideally wait till after earnings before you take it to a full or heavy position. We broke down yesterday. It was a slight close below. Today, we're clearly below the trend line, but again, today they report. You can see my blue line here. That means they report today. There was the last earnings report, the one before that, the one before that, et cetera, et cetera. And these are the same targets here. So if my fourth target is hit, and I will most likely add additional targets based on my longer term outlook, that's going to be about roughly 16% or 17% drop to that T4 level. And what it will do is also bring Apple down to the 200-day moving averages I have. They come in, the 200 exponentials right in line with this T3 207 price target. And then the 200 simple is closer down here to T4. So sometimes they buy one, sometimes they buy the other. And again, that's the takeaway is if let's see what happens, and then you might want to, if that's your thing, maybe you don't short. Maybe you want to at least get out of longs and sidestep. That's what I always say. There's many ways to use the analysis I provide on this site. I make no guarantees that any of it's going to be right, and I can only guarantee that I'll be wrong and wrong a lot. But the takeaways are often, in the little details of, how quick something may fall and what levels, once broken, I don't just give you the price targets. Like, for example, SMCI yesterday when the T1 zone was hit, the bottom of T zone, I made it very clear in that post. I quite often tell you when I'm going to go long and take trades, cover shorts and game a bounce. But yesterday I said I do not favor much, if any, of a reaction off T1 because we came too close to the top of that zone already. So I consider it effectively hit, and that increases the odds we're going to continue on down to T2 without any significant rally. And so, again, those little details are not so little that might have saved someone from trying to go long, because it's great support, but again, for the reasons I stated, that support got taken out, and that's pretty bearish to see. There's just no buyers stepping in behind it. All right, let's just cover the rest of them real quick, and then we'll get to the semis. I'm talking the rest of the Mag 7. So Apple will break down, but yet take it with a grain of salt. We'll know after today, certainly by next week, which way, if it wants to go up, eke out a marginal new high and have this be a whipsaw, or we're going to build on that breakdown. NVIDIA coming off that big divergent high, really second, it's almost an equal, call it a marginal. It is slightly marginal new high, big divergence. Remember, we were short there at that high, bearish engulfing candle. We milked it to the low, covered with impunity at the lows on August 5th, reversed, went long. We've had several trades since. This is even a look. If I was bearish back then, which I was, and I laid out long-term targets, which I still maintain, I gave them to you on the weekly chart. Thing is, nothing goes down forever. So we hit T1, we covered, we game bounced. I still maintain these targets, and now we're going to fall. You have an opportunity at the same level. Again, if it plays out, it may not. Just because it played out last time doesn't mean it will. So there's that uptrend line right now. You can see on the weekly chart, nice and clean. And we're right on it right now. This is this week's candle. So how we close this week or next week or 5 months from now, if this trend line, if NVIDIA continues to ride up this trend line, watch that trend line on a solid weekly close, just like you had a solid weekly close back here below the comparable uptrend line. And then boom, nothing but red sticks, nothing but selling. T1 was already hit. So again, I don't expect much of a reaction, if any. We may get one, we may get it on the 200 days again, just like we did back here, right off the 200-day exponential. But it increases the odds we're going to go through there, whether we have a reaction or not, and then hit these next targets down there, T3, T2. So now I'll get to the semis in 1 second. That's one reason I want to do the video. I just want to give you a quick overview of the Mag 7. Microsoft I already covered. Back to that board, broken down, post-earnings. Alphabet, a lot of giddiness on their earnings report. Just about all of which has been faded. So you can see my blue line here. If you can't, that's where we closed the night they reported. They reported, rallied the next day, and you can see they faded almost 100% of the post-earnings pop so far. You can't chalk it out as bearish. We're still above that post-earnings pop. But again, let's not forget, the market leaders peaked back in July. Some of them longer. Tesla peaked a couple years ago, and that's one of the Mag 7. So, keep that in mind, that this is nothing more at this point than just a counter trend rally. Only time will tell, if the bigger picture is playing out the way I think. You come down here, it was a divergent low, was it support? And then, this is kind of the bigger picture. And if that happens, we'll know at this point if those lows back. Most stocks peaked in the beginning, August 5th, but Alphabet was kind of an outlier, fell into a new low early September. But for all these stocks, look at those August 5th lows, or in this one, in the case, the early September lows. If we do reverse and these get taken out, I can tell you most people won't want to be shorting then, because the stock will have fallen in short order 18-20%. But it will increase the odds that those longer term, deeper targets are going to be hit. You have to respect or trade or analyze on different time frames. So a lot of people get stuck in the short-term charts, especially even, at times I suffer from that. I call it getting lost in the world of the intraday charts, the 60-minute charts. I'll be swing trading something like gold, GDX, those miners lately, swing up, down on the 60-minute charts. But then like today, I'm saying, look, and I've been pointing out, let's not lose sight of the bigger picture, the daily time frames and even the weekly time frames, because these little, zigzags, little EKG that's been working its way up, that upward price channel with corrections in between on GDX, at one point, if we break the longer term uptrend lines, the trend may change and we may be zigzagging or even waterfalling on the way down. So that's what we'll watch for here. So we'll see what happens after the rest of these report tonight. There's Amazon. And this is a busy, messy, sloppy chart, but the most salient, technical features are this. This is a divergent high right here. Here, I'll turn off all the lines and draw it for you. Remember, this was a divergent high in the top, like most of the Mag 7 stocks so far. Had initial leg down. Most things bounced off the 200 days and or trend line supports and bottom right here on August 5th and then went up. So it was just a brief undercut, which is common when you test the 200-day moving averages, and then they kept buying the 200 days. So again, these are the levels you want to see get taken out. And what I was showing you, what I was going to draw for you is just kind of a clean board here. I'll just hand draw it in. I can't. I'm trying to force this uptrend line. It's not super clean, but what I can tell you is clean is the divergence here on the daily time frame on what appears to be a counter trend rally so far. These stocks have had every opportunity to make new all-time highs, and they haven't yet. The majority of them again. What to watch for? Let me turn back all my lines. Again, the 200-day moving averages and this yellow line. It was a very significant level back then for me. It still was. I allowed that violation there on August 5th because of the reasons I stated. Everything else at the same time. The majority of market-leading stocks and indexes hitting the 200 days and or the price targets that I had. So therefore, it was just a brief violation followed by a recovery. Still a big level. That's why I have it color-coded yellow right there. And Meta, I already covered earlier. Broadcom rolling off a divergent high. We're going to get into the semis here in 1 second. Let me just update that divergence line right there. Again, these marginal new highs. This has been the MO for a while. And look, maybe it continues. We eke out, you make a marginal new high, and then you correct. This was a nice rip up, then you broke out, made a new high, and then you correct it again. So it's almost like old school trading says when a security breaks out to a 52-week high or an all-time high, it was bullish. And it used to be, you'd see a breakout because everybody at that point in time, you had nobody that was trying to get out of the stock. Everybody was profitable. But you can see this market's kind of been doing its own thing here. And it's these divergences. You just have the waning momentum. We've been in an uptrend as momentum continues to weaken. Volume I've warned of. That's a big thing too, guys. Remember in the last few weeks, even before the top that we shorted back in, when the market peaked in early July, I warned that was when my low volume indicator for the first time in a long, long time had triggered. And I just updated that with you recently and told you that it's plunged to extremes. And so believe me, that very much factors into the outlook here. So Broadcom, we'll get to the semis here in a second. I'm just covering what I'm doing if you didn't pick up on it. I'm going through the top components of the Nasdaq 100 here. And I just want to cover the Mag 8, whatever you want to call it. And so there's Tesla. Tesla, still one of my favorite longer term. Another failure again. I had initially, this was my bear market downtrend line. Then recently I added that purple line because they had so many clean reactions. Failed, and it's starting to roll over pretty hard after getting rejected on a failed attempt to get through there, especially on a weekly closing basis. But also the first time, as I mentioned, that we have negative divergence on the daily time frame since back here in mid 2023, and also a rejection at that previous downtrend line. And from there, Tesla fell 53%. So again, you can either profit. If it does that again, you can profit on the short side, or you can at least sidestep it and wait for a better long entry. And maybe it just doesn't pan out. What you can use my charts for, look at the support levels. There's a nice uptrend line right there that Tesla, quote unquote, the buyer should step in and buy. And if you're bullish, I tried to draw an arrow tool down there, you could. But anywho, if the market goes down, Tesla's probably going down with it. All right, now let's just go to SOXX and we'll wrap up here. Let me go to the 60-minute chart. Tell you we just hit T2, so I'm going to mark that as hit. From that most recent trade, we had these divergent highs here. I gave you a tight stop if you wanted it, but also told you I've had longer term targets for quite a while on SOXX, which I still maintain because we still peaked back there in July when the Nasdaq 100 peaked, and we're still well below that. And in recent videos, I told you this is a big old resistance zone, and so you can see we've had these divergent highs. We keep getting these corrections. And then one of them, so far, it's been multiple rejections off this level. We're down to T2. And you know what I'm going to do right now? I'm going to give you an uptrend line right here. I can see coming off this recent low. Yeah, we're right on that right now. And T2. That's support. So the semis, if they're going to do it, they need to step in here, I think, and rally. Again, charts to me, it's just so much here. I've covered this in recent videos. Potential head and shoulders pattern, left shoulder, head, right shoulder here, neckline downward sloping. So there's your left shoulder. Here, I'll draw it out for you without all the blurry stuff in there. Neckline, left shoulder, head, right shoulder. But as I told you in the last update, we need to start coming down impulsively, and you want to see it on increased volume. That is a criteria. The volume criteria is you need to see increased volume on the formation off the head, that drop down from the head, and also on the formation of the right shoulder. Ideally, that's how you want to scrub one of those, because they are, as I often say, one of the most recognizable patterns in trade. And I've seen Yahoo's always posting them here and there and post them on intraday charts. If, again, the essence of the pattern, for years, that's if you want to increase the odds it's going to play out, you want to scrub it for volume, like I said, and that would mesh with the market crapping out after Apple and Amazon report tonight. You're not going to see the semis do this and the Nasdaq 100 do this. You're just not going to. They tend to trade very similar. And then look at this beautiful uptrend line. I mean, there's a lot to like about shorting and being short the semis right now. And I think I have price targets for, I gave these to you a while ago here. We had this bearish rising wedge. That was a bearish engulfing candle, 101 reasons to be short there. And if not, right after the bearish engulfing and the breakdown of the wedge, this trend line was hit. This was T1. The first target was hit right here. Trend line was hit, was it? Oh, gosh. I'm trying to remember when I got these targets out to you. Either way, there's the trend line's been hit several times, including right now. T3, 4, 5, and 6 right there. And that would constitute a drop of another, I can't grab right on the line or it moves. So I'm going to start above and stop a little above, 31% more downside. So we're right there, guys. That's the thing. Look, we're on dual support. We're on price support. So you have price support here, gaps, and trend line support. It's also, the semis have also lost the 200s, but they tend to make these little brief drops below them, and then they step in and buy it up. At least that's been the MO. Sometimes they buy it right on there in a bull trend, but the further you get away from the 200s, the lesser chance it's going to be just a brief move through there, and then it's going to increase the odds. So that's how it works. That's how my brain works, incrementally, and at an increasing rate. The odds, as you get every tick below, each tick lower below the trend line in the 200 days, it increases the odds that these longer term targets are going to be hit all the way down here. All right. And now let's look at the components and we'll wrap up the video. So it's a daily chart. Let me go back to this board here. There's that same uptrend line right there. NVIDIA, I already covered quite a bit. We had a 60-minute chart too on it, and targets here. You have Taiwan Semi, big divergent high, breakdown, sell signal on Taiwan Semi. They must have already reported. Yeah, they already reported, so they're out of the way. So that means kind of gives you kind of the all clear to not have to worry about, you know, a false breakdown that gets reversed with an earnings beat. So there's a sell signal. Doesn't guarantee it'll stick, but it guarantees it is a sell signal. And I always, like I say, a breakdown is a breakdown until unless proven otherwise. Big negative divergence, big volume spike right here at the highs. That seems to be a blow off top buying climax. That was probably their earnings beat, which has all been faded and then some. It's at gap support right now, so you can't write it off completely. But again, it's just incremental. That's a sell signal break there. It's a sell signal and a break below 193.17. That was your previous high, and you gapped above it and then failed that breakout. And some traders will be looking at this gap right here. I'm talking about, I think you see it right there. And so if that goes, then it's just another support level taken out. And it's further going to increase the odds. We go down here, 175.89, 156.45. It's a good intermediate term swing target because you have the 200-day moving averages coming in there as well. And that's going to give you another 17% downside in TSM. Broadcom, divergent high, sell signal back here already broke down. It's been walking its way lower, coming up on I'm going to tweak that uptrend line right now, which I just did. I pulled it. I've had this trend line here for a while. Why did I do that? Just to fit the recent, it had two little whipsaws below. I think that's the best fit right there. So there's a big trend line. Set a price. I probably have 5 alerts on it already. And look at how beautiful it is. You have the 200 days pinched together right below it. So that you have triple resistance right there. Triple support, I'm sorry, quad. You've got nice price support there too at about 143.57. This is just like a lights out level. This is going to get excited when I see these kind of setups because you break that many support levels. The way my brain works is some people see the trend line. Some people see price support. They're bigger price support guys or gals. Some people are big fib traders. But so the more support levels that get broken in close proximity, the more people are going to short it. The more longs, which there's always a lot more longs in the market, are going to have stop loss orders that are hit and triggered there, or they just pull the trigger, including institutions. They see these levels. Warren Buffett might invest off fundamentals, but I'm sure I can tell you there's a lot of hedge funds and quants and all that. They're using algorithms and also factoring technical analysis, and the 200 days have been around forever. So that's it. ASML looking better than most. Not that what happens is positive divergence in a bear market. Just either doesn't play out or plays out for a short rally. You had a divergent low there and you had a rally, but then boom, look what happened. Those looking for new highs just got their clock clean. That must have been an earnings miss. It's got divergence by the skin of its teeth, but it's not confirmed. PPO is still pointing lower. It looked like it was going to make a bullish crossover, and the lines kind of pinched or kissed. You can see it got rejected there. So either way, I think there's better fish to fry shorting than ASML. I'm just covering the components. I won't hit them all because it's a little redundant. But the key is birds of a feather flock together. So if you can make a case on the big ones, when I do go through these watch lists, I go in order of market cap. So these are the big semis. AMD coming up on uptrend line support. There's a bear market downtrend line. Call it what you want. Symmetrical triangle pattern, but this was a top here. Divergent high, bearish engulfing candle, and an island cluster top. A trifecta of trend reversals. And right now, it's in a triangle pattern. So bulls can say it's a period of consolidation. This thing's going to new highs. Bears can say the top is in. No one can really say that definitively until this, or at least bears can't say that until this prior low, reaction low, is taken out. Then it will become much more clear to the masses that this stock is in a new downtrend. Uptrends are higher lows and higher highs, right? And downtrends are lower lows and lower highs. So we need to take out that low. Same thing with the markets. So it's August 5th lows. They're everything. It's going to be big if one taken out. All right, I'll probably wrap it up here. Qualcomm just broke this minor trend line. Texas Instruments. I could sit here and talk all day. Again, a lot of semis topped. And again, you have to ask yourself, with the massive amount of stimulus from the CHIPS Act, a lot of these U.S. chip makers, domestic chip makers, how are they not at all-time highs right now? If they've peaked and they're, the charts are bearish, and again, it's all in the technicals, that's just not a good sign. And I said it before, you get what happens in the chips equipment that's so cyclical. And after you see these crazy run-ups like this, it's just time and time again. What happens is it doesn't matter how much money federal government's going to throw at them to build new, production facilities, because it's making the problem worse. The problem is when they finally catch up to demand, when chips are the supply is short, the prices go up, and they have a lot of pricing power. And then all of a sudden, what happens is just like when oil is high, and what happens is all those wells. If you live out in Texas, West Texas, you see wells that were idle all of a sudden coming online. When the price gets high, everyone starts turning on the wells that weren't profitable, at $60 oil, but are profitable $80 oil. And the same thing happens when chip prices are high. They start pumping them out. And then at some point, supply catches up and exceeds demand, and then it crashes. And fewer sectors out in the stock market are more cyclical than the semis. And again, the technicals will tell you when that's likely. Divergent high, 68% drop. Divergent high, 29% drop. Divergent high, 28, 27, 20, 39, 48. And based on the technical posture of this chart, at minimum, I think we'll come back to this trend line, another 47, 48% drop. And that's just keeping it in a bull trend. And so if you're longer term bullish, buy there. God forbid this is a secular bull market uptrend line. These are cyclical bull and bear markets within there. If that breaks, then something uglier is going to happen. And no secular market, bull or bear, lasts forever. They can go for a long time, but either way, let's just look at right now. We'll worry about that trend line if and when we get there, what to do. Most likely be buying the initial drop to it. But there's what we're looking at right now, that beautiful uptrend line right here on the weekly chart, plus this price support right there, 188.80, 188.65. So this is kind of how I see the next year playing out for the semis. Drop down there to 189-ish, 190-ish, bounce, and then ultimately break it and come down to this trend line there. And then maybe time to buy some semis. All right, guys, I'm going to wrap it up here, get the video out to you, and we've got another hour and 15 minutes till the market closes, and then all eyes on Amazon and Apple. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.